Federal Reserve Chair Jerome Powell recently delivered a clear signal to financial markets that the time has come for lower interest rates. This announcement marks a significant shift in monetary policy, and it's sparking new opportunities and considerations for investors. Over the past week, U.S. equity markets have responded positively to Powell's statements, with major indexes like the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite seeing substantial gains. The markets are reacting to the anticipation of rate cuts, which would be the first in 4 years. These cuts could offer a much-needed boost to various sectors, particularly those that are rate-sensitive, such as real estate and small-cap stocks. Powell's recent remarks stand in stark contrast to his previous warnings about economic pain due to rate hikes. His speech can be seen as a reflection of the Federal Reserve's success in navigating the economy through the pandemic and managing inflation. With the economy now stabilizing, the focus is shifting towards the broader economy, especially the labor market. Let's look into what this means for your investments. Investors are now looking at different parts of the market to assess which areas still have room for growth, as interest rates are set to decline. Rate-sensitive sectors, which have already rallied, could see further gains if the Federal Reserve proceeds with the anticipated rate cuts. However, the future of small-cap stocks, in particular, may hinge on several factors, including the overall financial conditions, market volatility, and the strength of the labor market. A sharp deterioration in employment could lead to a less favorable environment for equities, which is something investors need to be mindful of. On the bond market side, the potential for lower rates offers a unique opportunity. While bond yields have spiked in recent years due to the Fed's aggressive rate hikes, there is now a window for locking in yields before they potentially fall. With the 10-year Treasury yield currently below its peak, now might be an opportune time for investors to consider adding bonds to their portfolios, particularly those outside of U.S. government debt, such as corporate bonds and mortgage-backed securities. Powell's speech has helped reduce some of the uncertainty surrounding the Federal Reserve's future actions, making it clearer that a rate cut is highly likely in the near term. For investors, this could mean that the time to act is now, as the landscape of interest rates and yields could shift rapidly. Impact on different sectors. As interest rates decline, various sectors of the economy will be affected in different ways. For instance, the real estate sector, which has been particularly sensitive to interest rate movements, might experience renewed strength. Lower interest rates typically make borrowing cheaper, which can lead to an increase in home purchases and real estate investments. This, in turn, could drive up property values and provide a boost to real estate stocks. Similarly, sectors like utilities and consumer staples, which often benefit from lower rates due to their stable cash flows and high dividend yields, could also see increased investor interest. These sectors are typically seen as safer bets during times of economic uncertainty, and lower interest rates could enhance their appeal. On the other hand, technology stocks, which have already seen substantial gains, might face a more mixed outlook. While lower rates could provide further support to these high-growth companies, there is also the risk of overvaluation. Investors need to be cautious and consider whether the current prices reflect the true value of these companies, or if they are riding on the wave of market optimism. Positioning your portfolio. Given the potential for significant shifts in the market, it's essential for investors to reassess their portfolios and consider where to allocate their assets. Diversification remains a key strategy, as it allows you to spread risk across different sectors and asset classes, including a mix of stocks, bonds, and possibly alternative investments can help balance potential gains with risk management. For those looking to capitalize on the expected rate cuts, focusing on rate-sensitive sectors such as real estate, utilities, and consumer staples could be a wise move. Additionally, keeping an eye on the bond market, particularly high-quality corporate bonds and mortgage-backed securities, might offer opportunities for stable returns as interest rates decline. It's also important to stay informed about the broader economic environment. The labor market, inflation trends, and geopolitical events can all influence market movements, so being aware of these factors can help you make more informed investment decisions. Investment strategies. Moving forward, as the Federal Reserve moves closer to cutting rates, it's essential to consider how best to position portfolios to benefit from these changes. Investors may want to increase their exposure to rate-sensitive sectors, such as real estate and small caps, while also considering the potential benefits of adding bonds to their portfolios. It's also important to remain diversified. While certain sectors may benefit more from rate cuts, the broader economic environment remains uncertain. Diversifying across sectors, asset classes, and geographies can help manage risk and position portfolios for long-term growth. Investors should also keep an eye on the labor market and other economic indicators. A sharp deterioration in employment could create headwinds for the stock market, particularly for small-cap stocks. Staying informed and being prepared to adjust strategies as new information becomes available is crucial in this dynamic environment. The impact on emerging markets. Another factor to consider is the potential impact of U.S. interest rate cuts on emerging markets. Lower interest rates in the U.S. can lead to a weaker dollar, which might make emerging market assets more attractive to investors. As the dollar weakens, the cost of servicing dollar-denominated debt in emerging markets decreases, potentially boosting these economies. For investors, this could open up opportunities in emerging market equities and bonds. These markets often offer higher growth potential compared to developed markets, and lower U.S. rates can create a more favorable environment for investment. However, it's essential to be mindful of the risks, including geopolitical factors and the relative volatility of emerging markets. Diversification and careful selection of investments are key when exploring opportunities in these regions. This consideration adds another layer of strategy to portfolio management in the context of potential U.S. rate cuts. By keeping an eye on global markets and the interplay between U.S. monetary policy and international investments, investors can better position themselves to take advantage of the shifting economic landscape. Powell's signal for potential rate cuts opens up various opportunities for investors, from equities to bonds. As the Federal Reserve moves closer to cutting rates, it's crucial to assess where the market might go next and consider how best to position portfolios to benefit from these changes. By staying informed and being strategic about your investments, you can navigate this changing economic landscape and potentially reap the benefits of the upcoming shifts in monetary policy.